Okay, so let us get started officially. I would like to welcome you all to the 17th session of seminar series of the Reigning Tesnیم Society. It's our pleasure to have Leo and Sam here. They kindly accepted our invitation. And just to give you a brief introduction, Leo is a mobile mortgage specialist for TD Canada Trust. He has been with TD for at least 6 years, right?
7 years.
7 years.
Yes.
And he specializes in residential home financing products. And also we have Sam Hashem, who is his realtor partner and will be available to answer any home buying questions that you may have. For sure, you're going to have some questions. So we'll have 45 to 1 hour lecture, but I think you're going to be shorter than that, as you said.
Yeah, I have a feeling, guys, you guys have a lot of questions. You're probably going to have even more after I finish up here. So we're going to not keep it short and sweet. My presentation will be about 15 to 25 minutes, depending on the flow of the crowd. Sam, I think, is about 10 to 15.
Yeah, mine's short. And if I could just say something, I'm really excited to be here tonight to present to all you guys. And I feel a lot of tension in the room, so I want you guys to loosen up because we're going to have a good time. He's a very good guy. I'd like to think I'm a good guy too. So hope you guys can trust us with the information and the knowledge we're going to give you tonight. And we really look forward to the question and answer period after as well, because we will answer any question you have on a business level. Personal wise, you can ask as well. You might not get the answer you want though.
Correct.
Okay. So please join me in welcoming these two guests, and hope you enjoy their presentation.
So thank you for having us, guys. Also, just to add to that at the end, I think we want to leave at the end, we want to leave a large ample room for Q&A, for questions and answers, because I think there's going to be a lot of them, and that's what we're here for, guys, to answer your questions. Okay. So thank you again. Like Ali said, my name is Leo Orellana. I'm a real estate secured lending specialist for TD Canada Trust. I've been in this particular role, commission-only based role, working directly in sourcing home business for just over a year now, but I've been working in retail banking for 7 years. I've been doing real estate secured lending for about 6 of those 7 years altogether. So I've pretty much seen it all, done it all. I work from new home purchases, refinancing of properties, new home builder financing, draw financing, spec builds, you name it. Okay, we do it all together. So anything real estate secured lending on the personal end, I'm your guy. My partner here, Mr. Sam Hashem, he's a great asset, and I think he's going to add some great value to the presentation in terms of not the financing side, but the home purchasing process itself, because there's quite a few other elements that you need to understand about that, and together we go hand in hand. Okay? Another partner consideration that we didn't bring today because it's not as important, but you're always going to have to be dealing on a purchase, especially in Alberta, you need a lawyer. It has to be a lawyer instructed purchase, so I would recommend either having a good recommendation for a real estate lawyer or having one prior to moving into a purchase, because you will need that trifecta: a lawyer, a lender, sorry guys, a lawyer, a lender, and a realtor, essentially to finish everything up for you. Can everyone hear me okay?
Yeah.
Wonderful. Okay guys, so let's get into it, essentially. So, what do I need to get a mortgage? What is required for me from a lender, in essence? And the way I like to put it down, essentially, is there are always 3 key elements that I myself are going to ask my client, or a lender is going to ask a client immediately when it comes to home finance. I call it the 3 hurdles, okay? Especially when I'm even meeting a first time or a prospective client, even over the phone sometimes I'll ask them these key questions, okay? Number 1 is income. Lenders, you can only borrow only so much money relative to your income, okay? So we have to confirm your income, and we have to confirm it through various ways: pay stubs, notice of assessments, letters of employment, you name it. But whatever you're going to declare to the bank, you can't tell the bank, oh, I make $100,000. Great, so do I. Prove it. So how do we prove it? You come in with your pay stubs, your letters of employment, you name it. And different applicants will require different sources of documentation for income, okay? Number 2, down payment. Now, there's different minimums for different purchases, but the standard for owner-occupied purchase in Canada, so your principal residence, is 5%, pending that you have citizenship or permanent resident status. And I have a slide at the end here that will describe what the minimum requirement is for non-permanent residents versus for permanent residents, okay? The down payment also has to be qualified. There's a lot of dirty money that gets cleaned through real estate. Okay, it's very easy to give someone $100,000 of illegal funds, put it as a down payment in real estate, purchase the property, flip it, move it, layer it into the system, and then sell the property and clean that $100,000. So the government has been coming down, the regulator has been coming down quite a bit over the past few years in terms of making us qualify and show that the down payment is from a qualified source, okay? Third and foremost, we were just kind of touching base on it, is credit. So I said credit history here, but it's actually, if you want to look at it, it's credit, and there's two branches of credit. There's the credit history and your viability as a borrower in terms of, do you pay on time, how long have you had credit for, how do you manage your credit altogether, and then there's also how much credit you currently hold. Because when we do the debt service calculation, we will always be looking at debt loads in total, okay? Because again, you can only take on so much debt relative to your income, okay? That's on the qualifying side, okay? Is everyone okay with income, down payment, credit? The three hurdles, fantastic, excellent. So income. There's many sources of income, many types of income that people can earn, okay? We have individuals that are salaried. That is the easiest, breeziest way to confirm an income. I love seeing pay stubs that say salaried, here's your salary on a valid pay stub dated within 60 days, perfect, okay? Hourly, gets a little trickier, especially in Alberta, because in Alberta you have people that have shift differentials, they'll work 3 weeks on, 1 week off, right? So it's not as cut and dry, but the bottom line is when it comes to hourly income, we want to at least have a letter of employment that states what your guaranteed minimum hours per week are. The bank does not like average, it does not like sometimes, it does not like kind of hits, it is guaranteed. Because there we can at least go, okay, 40 hours times 20 hours a week, that's $800 a week, and then we multiply 52 weeks by $800, total annual income, okay? Hourly plus overtime, a lot of folks in Alberta get overtime work, okay? Overtime is not guaranteed, so I know that you may make $100,000 a year, but if you just started a job that starts giving you a lot of overtime work, we may not be able to take that overtime in, and the reason being is because, again, overtime is not guaranteed. We will usually confirm it by receiving what's called your notice of assessment. Are you guys familiar with the notice of assessment document? Is anybody not familiar with the notice of assessment document? Be honest, guys, if you're not. Okay, so notice of assessment document. You file your taxes to the government, you declare everything, CRA, Canadian Revenue Agency reviews it, and then sends you back your notice of assessment. Typically it used to come with your tax refund or a bill, and it would be a blue piece of paper stating your line 150 total income, any deductions, any provincial deductions, federal deductions, any pension adjustments, and at the very bottom would be your RSP contribution limit. We are interested in seeing that line 150, total income, employment income, for the year. If we were going to base your overtime or consider your overtime, we will only do so by taking the average of your two most recent notice of assessments. At this point in time in the year, if you wanted to declare your overtime, I would have to ask you to bring in your 2012 and your 2013 NOAs. I take line 150 from 13, line 150 from 2012, add it, divide by 2, take the average, and submit that average as your total income, okay? So sometimes, again, if you just started a job that gives you quite a bit of overtime, and your NOAs are very far off, it may not work, or the average may not work well enough. Your salary may actually show more income than what your average notice of assessments will actually declare, okay? Commission-based earners, again, because there is no guarantee on income, I myself am a commission-based earner. We will always use the 2 years notice of assessment for commission-based earners. The reason being, there is no guaranteed rate of pay or frequency of pay coming in. You may have a great month one month, you may sell nothing the next, okay? So lenders are always wary with commission-based earners of taking in letters of employment. We will not accept them. Lenders will always accept average notice of assessments, or the other scenario is, Leo, I just started my commission-based job last year. I made a great income, but the year before that I was not commission-based. I made $100,000 last year on my notice of assessment, and this year, let's call it halfway through the year, I'm on pace to make $120,000. Is there any way that the bank will accept my income? As is, I only have one NOA showing my average. So what we can do on exception is if we can use your most recent assessment showing, let's for example, $100,000, and your current pay stub showing on pace to make $100,000 or greater, we can accept the notice of assessment on exception, just 1 year notice of assessment. That is on exception, okay? Not for everyone, we have to look at the deal and the client themselves. Traditionally, we can get that one pushed through, okay? Self-employed, business for self. The most difficult form of confirming income, okay? Because self-employed individuals are typically incorporated, once you incorporate your business and you receive all your revenue coming into the corporation, it is up to the individual to decide how much they will pay themselves in salaries and fees, as well as the individual can write off a multitude of expenses that can lower their net income prior to tax and then be taxed on a lower amount. So for that fact, when you're self-employed, especially if you're incorporated, the bank is also going to want to see 2 years notice of assessments for self-employed. And it's typical because if you actually don't, everyone who's self-employed traditionally will talk to their accountant and their accountant's going to say, no, pay yourself $38,000 a year. You don't want to pay any taxes. Great. But when you go to the bank and you give the average $38,000 or 1 year $39,000, 1 year $38,000, guess what? The average is $38.5. That qualifies you for nothing. Okay, so you have to be able to talk to your accountant if you're self-employed and you know that you're going to be submitting, paying yourself a salary from your corporation, and we're going to be using that salaried income as the line 150 of your notice of assessment. If you're planning on making a major purchase or major finance, talk to your accountant beforehand and say, I need to find the perfect balance of reported income that I can pay the least amount of tax possible, but enough income that allows me to qualify for the purchase that I have in the future, okay? Because I gotta tell you how many times, I don't know how many times I run into self-employed individuals that did not take that into account. Yes, they're making great money into their corporation, but they're paying themselves very little. And unfortunately, it is not the corporation that is applying for the mortgage. It is the individual. And because a corporation has rights like an individual, that's why people protect themselves through a corporation. If we did an application to the corporation, now you're talking about a business application that's a mortgage loan A, which is a different product, different rates and different terms altogether. Will we take into account how much someone is making in their corporation? Absolutely. Again, credit is never black and white, right? It's always gray. So if we want to go on the strength of the corporation, the fact that the corporation is indeed making quite a bit of money, but the client is paying themselves very little income, the underwriters will consider that, but we need to submit the T1 generals, T2 generals, and 2 years worth of financials to support the income, the assets, and the income statements showing on the corporation. And if the corporation is indeed generating enough revenue, they may grant an exception and grant the application. But anyone who is planning on going for business self, please, and looking to do a major financing or a major financing purchase, and it's going to be self-employed, please keep that into consideration. Talk to your bank beforehand and ask them, I'm planning on buying a $400,000 home in a year or two. This is how much I'm paying myself. I'm incorporated. What is the perfect mix of income? Where do I qualify? Take the initiative to talk to the bank first and run those numbers to see if you actually qualify with the income that you're planning to pay yourself. Rental income. Hot topic right now, guys. If you have a rental property, traditionally the banks will only accept, some were accepting up to 60% of the rental income on a valid lease agreement. Okay, I'm renting a property out. I have a renter paying my mortgage right now that I own the property. I have a $1,300 a month in lease payments coming into my account. Most lenders, some we're a little different now, we're all on the same base. 50% of your rental income is all that the lender will take in, okay? So even though you've got rent coming in for $1,300, the lender will only consider $650 and add that to your income. If your mortgage is at $1,000 on that property, guess what? There's no profit there because we're only taking in $650, but you also have to show a mortgage payment when you're qualifying of $1,000, and that may not help you. We can do a rental analysis. Traditionally, if you have more than one rental property, we can do what's called a rental analysis. And if indeed you're showing rental income coming in, and we can account for all expenses, and at the end of the day, we have a very conservative approach to it. We go with our analysis. But if at the end of the day, you can show a debt service level or a DSC greater than 1.1, or essentially, after we've taken into account all the expenses that we see fit, it's a formula that we use, and you're still showing positive rental revenue after our analysis, then we will actually eliminate your debt costs at the end, and we'll actually take in that surplus rental income. That's a little more advanced, because everyone I think here is going to be a first-time home buyer, so we won't really get into that, okay? And etc. There's always different ways that people earn income. Okay, income, 5 most common types of income confirmation, as I mentioned before, letter of employment. The key to that is guaranteed minimum hours or a statement of salary. If you guys ever need an example, you can email me and I can send you some templates of perfect letters of employment that we like for hourly earners or for salaried earners. Pay stubs, very standard, everyone gets a pay stub usually. The key to the pay stub is it's got to show the employer's name, it's got to have a year-to-date earnings on it, because the underwriter wants to see, okay, you're earning this much, but how much have you earned year-to-date? Because if you are salaried, we can pretty much do a simple calculation. Okay, this is your salary every 2 weeks, this is how many 2-week periods have passed. Your year-to-date should reflect what your salary is earned altogether. It should show deductions. Most pay stubs will show deductions, CPP, EI, things like that. They just have to be valid. Different lenders have different criteria. Ours are pretty standard. Direct deposit slips. Those get a little tricky. You can't have too much variance in your direct deposit. So we'll take 2 months worth of direct deposits, TD in particular, we'll take 2 months worth of direct deposits from your account. We'll take the average of all, let's say if you're paid bi-weekly, we'll take the last 4. If the variance in between the last and the first direct deposit is greater than 5%, the average variance is greater than 5%, or the variance is greater than 5%, we cannot accept the direct deposit. So bottom line is, there cannot be much fluctuation in your direct deposit for us to use it as income confirmation. If you get paid like clockwork, you know, $2,800 every 2 weeks after tax, beautiful. Then we can use your direct deposit, we can use your income and confirm it as such. 2 years average consecutive notice of assessments. Most people have those. They may or may not help the situation, but depending on your income class or how you generate your income, you may only have the option of using 2 years average notice of assessments. Traditionally, self-employed, commission-based earners, and overtime, people who want to declare overtime. Account prepared T1 generals. Those are very comprehensive income preparations for the CRA. We will use account prepared on exception if you don't have the notice of assessment. For example, Leo, I just finished my taxes, but I haven't filed and received the return back from the government. Can I use my T1 general, which is the tax return that the accountant's going to submit? Yes, you can, as long as it's a certified account. We cannot use your uncle who did your taxes for you because there's no accountability there, right? If you go to your uncle and say this is incorrect, he's going to say, well, hey, you did it for free. I did it for free. What are you blaming me for, right? But if it's a CA, there's accountability with a chartered accountant, right? That's their profession. If they're signing off on that document, we can hold them accountable for any incorrect reporting that's there in the event. Perfect. Just flip over. Down payment. All right, guys. So, minimum down payment for owner-occupied principal residence in Canada, 5% down payment, okay? That's 5% of the purchase price. The first 5% cannot be from borrowed sources. It has to be cash from own resources. So that's from income, savings, income from investment, transfer over from overseas, wired, if you'd like. That gets, again, with anti-money laundering legislation, that gets a little complicated. Or we might have to show a little more documentation of where the income was sourced, because it gets a little, you know, where is it coming from, right? What is the source of the income? As well as if gifting. Now you can receive, for your first 5% down payment, you can receive a gift from direct family member, okay? Not from an uncle, not from an auntie. You can receive from grandparents, parents, and siblings, okay? That is the only qualified source of a gift for income, owner-occupied income. If you want to put 10% down, we will allow a gift from employer. But the minimum for that is 10% down payment, and we will accept a gift from employers. Sometimes employers use a gift for a mortgage as an incentive to get an employee overseas or from another country to come and work here. And one of the benefits they'll say is, if you put 10% down, or if you want to purchase a home will lend you or will loan you or will gift you the money as an incentive to come to work here, okay? Must be able to show a 30-day running history of funds. So if we don't have a gift letter on hand or a signed-off qualified gift letter, if you were going to show the lender, yes, I'm getting a gift from another institution, the minimum requirement is that we need to show a 30-day history from the account from which the gift came from. So if you're getting a mortgage from TD, which I'm hoping all of you will, and you bank with CIBC or BMO, then what I'm going to have to do, you have your gifted funds or your down payment funds in another institution, be prepared to come in and show a 30-day running history from the date of application, 30-day history that the funds have been in your account. All we need is 30 days. It's a magical number, okay? And as long as the funds have been in account for more than 30 days, qualified, okay? Down payment can also be from gifted by immediate family members. There's no limit, okay? So we've discussed that, and the nice thing is there is no limit to the gift. Just keep in mind that the underwriter is going to say, oh, a $200,000 down payment, all gifted from the family member. They may or may not ask for more information, okay? It's all about reasonability, guys. You can borrow funds for a down payment, but it must be paid off before the mortgage funds, deposit loan program. That's a specific program to TD Canada Trust. If you're looking to do a builder deal, essentially you're going to a home builder and they say, we'll have this home built for you in 12 months. A lot of people are opting to do that because some of the inventory in the resale market just isn't what they're looking for. It's not modern enough, it's not in the right neighborhood, but we want a nice modern home in a newer neighborhood, but there's nothing out there, we have to go through a builder. Traditionally, a builder will take anywhere from 6 to 12 months to complete a residential home. That means that gives you 6 to 12 months to come down with the remainder of the down payment. The way most builders work is they're going to want 10 or 5% down payment. If it's 5%, they're going to want all the down payment up front at the time of signing the contract. If some builders require a 15% down payment, they're going to want 5% at the time of signing the contract and the remaining 10% at the time of closure. If you do not have the 5% or the remaining 10% at the time of closure, we can qualify you for a loan that will allow you to have the gift money now, which qualifies the down payment. The key to that is you need to have the loan paid off prior to funding. So before you take possession of the home, you have to pay off the loan, and here's the best part about it. We're not going to verify where the source of the payment to pay off the loan comes from. You just need to pay off the loan before you take possession. So this is, in a way, a very crafty way of sometimes getting around the down payment. It's only available sometimes for a builder because you need a long time frame, at least 10 to 12 months, maybe minimum 6 months before you're required to pay off that loan. Okay, so just wanted to make a quick note of that, guys. Okay, home buying process. Sam's gonna go over a bit of this too, a little bit of an overlap. But essentially when you're buying a home, I highly, highly, highly recommend that you come in and you talk to your lender first and you get a pre-approval, okay? Why do you wanna get a pre-approval? Because the worst thing is to go shopping for a home, fall in love with a home, your wife absolutely loves it, it's the right neighborhood, it's the right kitchen, you know, happy wife, happy life, you guys go and you make an offer, it's pending, you're getting really excited about the idea of living in this place, you go to the bank, boom, not approved because of a variety of scenarios. So what I usually recommend is go to your lender or TD Canada Trust, give me a call, we'll talk. Go to the lender, pre-approved, and we'll definitely tell you then and there what are the odds of you qualifying, or we'll find your maximum purchasing power. Once you're armed with this maximum purchasing power after you've qualified income, down payment or whatnot, you can then enter the market knowing that, hey, I can buy up to this point, but that doesn't necessarily mean you should purchase a home that expensive, okay? Because there's one thing of what you can afford, and there's another thing called what I should afford, okay? That's a discussion that each one of you have to have with yourselves or in your own households, because I'm telling you, I've applied people for 400, they're going for 3, and they end up buying 385, because that's the price point for the features of the home that they like. So, once you get the pre-approval, you're moving into purchase a home, okay? Now, pre-approval is just that, guys. It is not a guaranteed approval because the lender has not reviewed the security or the property that you're proposing to purchase. There's been times when someone wants to buy a home, but for any which reason, the lender does not like the property, they will not approve the property or the loan. Not to say that they won't approve you on the purchase price, the lender doesn't like the security for any reasons. It's got issues, it's too old, It's in a high-risk not neighborhood, but in a high-risk area where there's environmental hazards, whatever the case may be. So always remember that a pre-approval is just that. It's, hey bank, here's my income, here's my down payment, here's my credit, what would you be willing to lend us up to, okay? So then you meet up with a realtor or an individual such as Sam. You go shopping for homes, you make an offer to purchase. I'll let him get into what the offer to purchase looks like. You come back to your lender, and now we put in what's called a full approval, okay? This is everything that we've done before and now the details of the property, okay? Once we check the property, the bank may or may not like the purchase price, okay? Whenever you're looking at the value of a home, there's a range that the home's gonna fall in, the postal code, okay? Each lender has price ranges for postal codes. They're not exact, but it's a range. If your purchase price is below that range, the bank will trigger an appraisal. It needs to confirm the value of the property that you're purchasing, okay? Because that is essentially the collateral that the bank has. Do you guys understand why it's so important for the bank to understand the value of the property? Because if you go belly up, you declare bankruptcy, we're going to get rid of that home as quick as possible. And hopefully that home is indeed valued at what you had recently purchased it for, or for the appraised value that the appraiser has given us, okay? If the value of your property, the purchase price of your property is above that range, also another reason, why are you paying so much for the property? Maybe the loan we're going to lend you is more so than the value of the property. We don't want to lend you more than what the value of the property is. And you also don't want to pay more than what the fair market's going to offer you for the property. So if it's above range, the bank will also trigger an appraisal. If you're within range, approved, no appraisal required, okay? And we move on with a full approval. Mortgage default assurance on approval. So if you have less than 20% down payment in Canada, by law, you are subject to what's called CMHC insurance. Okay, you guys are gonna love this one. CMHC insurance. Ooh, did I turn this off? Can you guys hear me?
Yeah.
Okay. No? Here, let me fix this. So CMHC insurance, guys, is essentially an insurance that the purchaser pays up front, will roll it into the mortgage, that insures the bank in the event that you default, okay? It's a one-time It's a one-time upfront cost rolled into the mortgage, and what happens is basically if you default on the mortgage, if we have to foreclose on the property, and let's say, you have to understand, the bank is not in the business of selling homes. If we foreclose on a property, the bank wants to get rid of that asset like that. We want to close the loan, we want to just call it quits, that's it. We're not sitting there fixing tables, vacuuming, making it nice, and waiting to see if we're gonna, no. We go to a foreclosure, here's a realtor, here's the mandate, get rid of the property and move it, okay? So, if we want to move it quickly, and if the property values, for example, if there was a shock in the market and property values actually dropped, let's say you owe $295,000 on the mortgage, but the home only sold for $240,000, guess what? The bank's out $55,000, right? On a bad deal, essentially. So what CMHC insurance does is, as long as you put 20% down, everyone is subject to CMHC insurance premium on the property, and if you default, the bank's losses will be covered. The benefit to that is that you can actually purchase a property with up to as little as 5% down, which, if you think about it, in the grand scheme of things, 5% is not a lot of money in the overall valuation of the property. So A-lenders will give you great interest rates, such as the 5-year 2.99, 4-year 2.77, which, guys, I gotta tell you, are historically low interest rates in Canada. Historically low, okay? They will continue to give you those terms. They will continue to give you great pre-approval, prepayment porting options, as long as you're CMHC insured, okay? I'll send you guys a little bit more information on that, because there's premiums or whatnot, but to give you an idea of what the premiums are for CMHC insured mortgages. Right now, if you're in the highest premium bracket with only 5% down, that means you're 95% loan to value, right? The bank is lending you up to 95% of the value of the property. You'd be paying 3.15% of the borrowing amount as your CMHC premium. The brackets go from 88 to 85, 85 to 90, and 90 to 95, each with its individual premium. The more you put down, the less you pay in CMHC insurance premium altogether, okay? And then eventually, voila, home sweet home, you guys get your keys, you deal with the lawyer, you're in, and you're a proud homeowner. this actually isn't a slide for you guys. This is kind of like what a prospect, right? So direct advertising referrals, you can switch on this one, Sam. Pre-approval, critical first steps for pre-approval. How much could you afford? That's essentially what you're looking for. Okay, well, how much is the bank willing to lend me based on my income or our joint income and our joint credit scores and our down payment, qualified that is. The underwriters, there's 5 C's of credit, okay? And that's why I say that credit isn't always black and white. There are many aspects that an underwriter wants to know about a borrower. Obviously, there's the credit score and income and all that. But when you want to start talking about a client's viability and where my job comes in as an expert, if the deal's a little so, I'm going to touch on these points. And that's where a lender may ask you for more information. And that's why it's great to be able to show this kind of information. So character. Character is essentially credit history. Do I pay on time? How many credit products do I have? And what is my payment history like? And how long have I been paying on time? The longer a credit history with solid payments, the greater your credit score and the lower the risk of you defaulting altogether. Capital. So your net worth. So when you take all your assets, everything you own, cash, any kind of asset you have, and if you were to liquidate it and turn it into cash, and then you took all your liabilities and you were to pay them off, what are you left with? If you're left with positive cash flow, that's positive net worth. That means you own more in value than you actually owe. If you sell off everything and pay off your liabilities and there's still debt, that's obviously negative net worth. That is not a good position to be in, because if you had to go bankrupt, you're still going to owe money, which means somebody's going to be left with their hand out and receiving nothing, and one of the lenders. Capacity is your ability to pay, so cash flow, that is your income. We're always going to confirm your income. Can you service the debt? Do you make enough money to be able to carry the current subject property request or the mortgage that you're asking for on top of all your other debts? Credit cards, lines of credit, student loans, you name it, okay? Collateral, that is when we're reviewing the property. What is the security, what is the collateral that we have on place, okay? Do we like the home? Is it a big home? Is it marketable? Here's one of the biggest fallacies that people think about properties. The more expensive my property, the more willing the bank is to finance. Incorrect. Once you start hitting $1 million property, you have to think, how marketable is $1 million property? How many people do you guys know that are buying $1 million homes? Not many, right? The average home price is around what, $340 a year right now? That's central?
About 350, yeah.
350 is the average single family unit home right now. So that is your most marketable price range for a home. If the bank had to get rid of the property quickly, a 350 home is going to move like that compared to $1 million home. Because $1 million home is marketable. Okay, so that ties into collateral, and also, you're buying a home, a condo, and where is it located, right? Major city areas, much easier to foreclose, sell, or move over a home versus a lake property. That is, maybe some people go to that lake. Maybe some people are interested in buying a property there. And last but not least is the most important C, credit. So just borrower's history overall credit analysis. Okay, and that's where the score range comes in and a whole bunch of other factors. But those are the 5 C's of credit. Okay, guys? Pre-approval, interest rate guarantee. What's the nice thing? Why are you getting a pre-approval? Why would you go into the bank to consider a pre-approval besides your maximum purchasing power? Well, interest rates are low, and there's no guarantee that they're going to stay low, although they've been low for quite a while. And I'm not going to, there's experts saying every year the rates are going up in a year and a half, the rates are going up in a year and a half. I've been hearing that song for 5 years, guys, okay? So bottom line, my consensus is nobody knows, okay? The rates last year, for example, fixed rates on a 5-year term, in June we're at 2.89%, 10 basis points lower than they currently are now. But from June to the end of July, they shot up 1%. Why? Because the yields of government risk-free bonds increased. So people all of a sudden who didn't have a pre-approval, when their neighbor got 2.89, just 2 months ago, they went into the bank, all of a sudden the bank's offering them 3.79, 3.89, and they couldn't believe it. Why? We don't dictate the rates, we only have to abide by what's offered on the market, okay? So pre-approval allows you to book a rate while you're shopping for 120 days. That's TD's pre-approval range. Some lenders will only give you 90 days, we give you 120 days altogether from TD Canada Trust. From the time that I book that rate, you can close the deal within 120 days and we will honor that interest rate, okay? Documentation required up front. It is always better to bring your documentation up front and confirm everything instead of finding surprises at the time when you actually are making a live offer on a property, okay? So I always recommend to my clients, let's confirm everything on the pre-approval, let's have the file ready to go, and let's have it all packaged. So when you do make an offer, no surprises. And no having to run around to the bank and get more information and phoning the CRA or whatnot. Confidence that the financing will be in place. Well, you can walk out saying, hey, we're pre-approved, you can go talk to a realtor now, and we know that we've got all the documentation in place, we can talk to the realtor, we can confidently tell the realtor, you know what, I think we're good for purchasing up to $400,000, or whatever the case may be. Save time. Again, once you get pre-approved and you know that the pre-approval's in there, you don't have to run around phoning other realtors, other whatnot, other lenders. You can if you'd like. That's completely up to you. This day and age with all the information on the internet, I mean, you can get from your phone, you can start finding out what the best rates are or offers altogether. But it allows you to save time in terms of having to run around and pre-approve at multiple institutions. And also no surprises, like I said, no surprises at closing time, guys. You really, when you want to make that solid offer on the property, you want to just make sure that you give me, the lender, your offer to purchase. I plug in the deal, I send it in, it's approved, boom, send you the branch to sign. Fantastic, congratulations, remove your conditions, you're good to go, okay? Financing options, mortgages versus home equity lines of credit. Do you guys, anybody know what the difference is between a home equity line of credit and a mortgage? No? Okay, mortgage is a fixed rate product. It is guaranteed rate for the term that you locked in. So 5-year term, 60 months. That means that your payment does not go up, it does not go down, it is flat, it is fixed, okay? Great for the budget, great for being able to say, hey, even if my income doesn't increase, I know exactly what my fixed payment on this property is, okay? The flip side to a fixed mortgage is that it's rigid, okay? Because it cannot move or change, and because it is a set contract. If you need to break the mortgage or move the mortgage, you can either port the mortgage, which we'll talk about later, or you have to cancel the product. If you cancel the product, you will face 2 types of penalties. The interest rate differential penalty or the 3-month interest penalty. The greater of each at the time that it applies will be applied to the mortgage. The interest rate differential, what is it, Leo? How do you calculate it? Impossible. Because it's dictated on what the mortgage interest rates are at the time that you're closing, how much principal is remaining, and how much time is remaining on the term. The key to that essentially is, in a rising interest rate environment, you'll most likely maybe only face a 3-month differential penalty. Because the way you gotta look at it from a lender is, it's tough not to write. I'll do an example for you guys after if you guys have a question on that. But bottom line, in a rising interest rate environment, you will most likely only face a 3-month interest penalty. In a flat or a decreasing interest rate environment, you're most likely going to face an IRD, and man, oh man, have I seen some steep penalties when it comes to people trying to get out of a mortgage. And what you got to remember, guys, is life has a way of throwing you curveballs, okay? I may plan on living in this property for 5 years, but I could all of a sudden have 2 kids and get an offer in Calgary. Boom, gotta move, right? I need a bigger house, and I gotta move to a different city. So then you gotta start looking at your options, and sometimes people get a really rough surprise when they lock into a fixed rate and then they have to cancel it, okay? Home equity line of credit is a line of credit secured by a property, okay? It is revolving, it is not fixed. Right now, our offer on home equity lines of credit are prime plus 0.5%. That's currently 3.5% on the revolving balance. The minimum payment is interest only, so it's quite flexible. This is a product that you're looking for if you want to be able to pay down as much down payment or as much to the principal as you'd like. If you want to maybe hold the property and you're not too sure how long you want to be in it, so you want to sell it, okay? And you don't want to have any penalties. You just want to be able to pay out the property and that's it, okay? Problem with home equity lines of credit is that, and I'll get into some more specifics later, but the maximum loan to value on a home equity line of credit is 65%. So traditionally, first-time homebuyers do not qualify for this product, because that essentially means that you need to put down 35% on your property and the rest will finance as a home equity line of credit. So this is a little more of an advanced product, not necessarily a first-time homebuyer's product unless you have a significant down payment, guys. So, there we go. Okay, mortgage, fixed versus variable. I'm pretty sure everyone has questions on fixed versus variable. So fixed we touched base on quickly. It is great for budgeting. It's great for peace of mind. Your rate does not go up or does not go down for the term that you've locked in, okay? but it is the most rigid product as well too, which means if I need to get out of the product, I can either port it, and I'll get into what a port is later, or I have to break it and pay the penalty, whichever of the two apply, okay? Versus a variable rate means that your rate, variable rate essentially moves with the prime rate. Currently, TD's offering on its prime rate, prime minus 0.55, or essentially 2.5%, okay? The prime rate is dictated by the Bank of Canada's overnight lending rate, okay? So when you hear about Bank of Canada making a decision, BOC requirements, and that they've moved the rate up, expect your variable rate products such as variable lines of credit, any variable product to move up, the interest cost to move up. Now with a mortgage, if your prime rate goes up, your mortgage payment does not increase, but the portion of your payment that is interest increases. Thus your amortization will stay longer, or you will be paying the principal down at less speed, or at a shorter or a longer amortization period than originally established. What is the advantage of taking a variable rate product? Number one, it's this. If you ever want to cancel the product, because it is not fixed, you will only ever face a 3-month interest penalty, okay? Because it is not pegged to a set interest rate. So that means that, for example, if 3-month interest at the time of cancellation, your interest is $800, well, that's what, $2,400 to get out of the product. Not too bad, quite flexible. Also, if you believe, or if you're in the state of mind that the interest rates are gonna stay low, the prime rate's gonna stay low, which, by the way, the prime rate, guys, has stayed at 3% for the past 5 years, then you're gonna benefit because you're actually at a lower interest rate than what the fixed rates are being offered at the time, okay? I'll give you an example. My mother's variable rate, she got 5 years ago, she was at prime, this is when they were offering prime minus 0.8. So her interest rate is 2.2, and she stayed at 2.2 for 5 years. And believe you me, she aggressively paid that mortgage down, because she said, while it's this cheap, I might as well pay down my principal as much as possible. Okay, that was her game plan. She had the cash flow to do it. She's a bit older, she's got some good income coming in. But that was her advantage. And when she renewed back into a variable, because she's gonna have this thing paid off in a 1.5 years, and she does not see, in her mind, she's not seeing the variable rate increasing or the prime rate increasing, okay? I'll give you guys a bit more information if you want to talk about me a little bit more specifically on fixed versus open or variable. Just send me an email, give me a call, or let's make an appointment, okay? Term, closed versus open, very simple. All the mortgages that we've been discussing right now are closed term mortgages. What does that mean? You have entered into a contract with the bank. If you close it, there will be a penalty, okay? It is closed. There is not open to discharge. Versus open, the most flexible product there is. A home equity line of credit is an open product. That means that any time you want to pay it off and remove the lien from the property or discharge it, done like that. As long as you got the money, pay off the balance, and we're great, okay? Open term mortgage, same thing. I'm not too sure how I want to be in this property. I'll give you a perfect example. U of A contract worker coming to the U of A from the United States has a 2-year contract at the U of A, does not know if he's going to renew it, but wants home ownership, doesn't want to rent, has money, has about $170,000, $200,000 to put down on a property. I'm not too sure what I want to do, Leo. Well, let's either do a home equity line of credit or let's leave the product open, because at any time you can close it, or do a maximum 2-year fixed, because he's got a 2-year contract. So do a 2-year fixed mortgage, and at the time of maturity, you can then decide if you want to leave it open or not. Okay, so that's the biggest difference between closed versus open. Mortgage loan agreement, that's essentially just the mortgage agreement itself. So if we were to do a deal together, we got you all financed, I would then send you off to the branch, and you guys would sign your mortgage loan agreement with TD Canada Trust, review all the terms and conditions, give it your Johnny Hancock, and gravy. We got a deal, and we'll push to the lawyer, okay? Amortization and the length of term best suited to the client's needs. Do you guys all understand what you guys know what amortization period is, right? Does anybody not know what the amortization period is? Be honest, guys, it's okay. That's what we're here. We're here to learn. Okay. Amortization. So whenever you're looking at a loan, there's always an amortization period. It's a very common term in accounting as well too when you're discounting the life of a product. If an amortization period is the total time that you're allowed to take to pay off the mortgage to zero. Okay. So on an insured mortgage, when you have less than 20% down, new rules, July of 2012, government regulator rules said that you can only take 25 years to pay off the mortgage. Okay? So when the longer of an amortization you have, the smaller your monthly payments. The shorter an amortization you have, the larger your monthly payments. So when it comes to qualifying, you may say to yourself, oh, I'd love to have this paid off in 10 years. but your payment might be so large that you will not qualify. So, just remember this, the longer the amortization, total time to pay off the mortgage, the longer the amortization, the smaller the monthly payment. The shorter the amortization, the larger the monthly payment, okay? Perfect. First mortgage, so conventional mortgage. A conventional mortgage is when you have minimum down payment of 20% or greater. The terminology used in the industry is conventional, which means it is not insured, okay? Two things happen when you don't have an insured mortgage. Number one, the government allows your maximum amortization to go from 25 to 30 years. That means that your payment can be smaller and it may help you qualify depending on the purchase price that you want, okay? Versus, the second thing that happens with a general conventional mortgage is no CMHC. So guess what? Get rid of the underwriting at CMHC, we don't have to push the deal to them for review, and there's no premium that you pay. So depending on your purchase price, that could be about $12,000, $15,000, $18,000 that you're not rolling into the mortgage. So you're avoiding that cost as well. So that's why you'll hear a lot of people say, try to put 20% down. Again, first-time home buyers with these market prices, these home prices, probably not the case, especially if a lot of you are coming out of university, probably got student loans. You're probably going to have a pretty good paying job, but the down payment's going to be very limited, okay? Versus default insured mortgage requires as little as 5% down payment, okay? So anytime you have less than 20%, CMHC insured, that is called a high ratio mortgage, okay? Next page. So let's compare. Conventional mortgage, purchase price, $250,000, 20% down payment, that would mean $50K, very simple math. Versus a high ratio mortgage, $250,000, minimum down payment, $12,500. You can see that this is a significant difference, and when you're coming out of school, you're usually on that side of the column, not this side of the column, okay? So, default mortgage insurance, it applies to purchases with less than 20% down payment. We're getting a little repetitive here, guys, sorry. And insurance premiums can be combined with the mortgage amount, okay? We roll it into the mortgage. You have the option of paying the CMHC insurance out of pocket. Why would you do that? Why wouldn't you just put more money towards the down payment? Okay, so if you are going to take CMHC insurance, let the institution roll the premium into the mortgage and just absorb it into the total principal that you're borrowing. Okay, self-employed individuals. TD Canada Trust works with Canadians running their own businesses or individuals who earn non-salaried wages. The maximum loan to value for self-employed individuals applying under insured business for self-stated income up to 90% loan to value and up to 80% for refinances. What does that mean? If you're a self-employed individual and you want to make a purchase, and we're going to use a gross up or self-stated income, okay? Sometimes, indeed, you report less than what you're making, and we can use greater than what the NOAs are reporting, but you have to keep in mind that the minimum down payment the banks can ask you for is 90%, okay? So be prepared that if you're self-employed or you're using strictly NOAs, and you want the bank to give you an exception to your income, be prepared to put 10% down. For self-employed individuals or any refinance of a property, the maximum loan to value for any refi is 80%. So to give you a very simple explanation, I have a $100,000 valued home where it's been appraised at $100,000. I owe $50,000 on it, but I want to take equity out of the mortgage. We will refinance you up to 80% loan value, or we will give you an additional $30,000 to a maximum of $80,000 against the fair market value, pending you can service the debt. Okay, so I just want to make those 2 points. Must be able to provide the applicable documentation to confirm income for self-employed individuals. That's show us your financial statements, show us your statement or certificates of incorporation, articles of incorporation to prove when you incorporated, and obviously good credit history, right? Additional costs. So there are additional costs to just the principal and the interest when you're considering a mortgage, okay? Additional costs, there's land transfer tax. That doesn't really apply. There's no land transfer tax in Alberta, sounds mostly Ontario, BC.
Yeah, it's not here, but
okay.
There's other things they got to do.
Land transfer tax is something that applies in Ontario. It can be quite steep. Luckily, you're in Alberta, the land of no PSC and no land transfer tax, so that doesn't apply in our case. Legal fees. Traditionally, the legal fees, we have to also show when you're confirming your down payment, we also have to confirm that you have the legal fees to be able to close the deal. In Alberta, we look at the legal fees, or our underwriting department will look at legal fees as 0.05% or 0.05%, or is it, sorry, 0.5% of the purchase price. So whatever your purchase price is, multiply by 0.5%, and you have to add that on top of your down payment and show that you have that to be able to close the deal. Depending on the lawyer that you get, they may charge you anywhere from, I'd say the range goes from $1,100 to $1,600, sometimes $1,800. That's what it'll usually cost you to close the deal. And I'll tell you this, guys, the lawyers, they do nothing, but it's the conveyancer who does all the work, and then the lawyer goes, oh, okay, they do an appointment with you, say, okay, everything looks good, all right, here, sign here, thank you very much, that'll be $1,600, see you later, okay? But unfortunately, in Alberta, you have to do solicitor instructed purchase, okay? If you're refinancing a property with an institution, then we can use legal service providers such as FCT, which will just register the lien, not give you any legal information whatsoever, but just register the lien on property, and it's usually around $300, $335, okay, very cheap compared to a lawyer. Adjustments, prepaid property taxes, condo fees, you always want to be prepared for that, okay, because the bank, with less than 20% down, the banks or most lenders will require you to pay the bank to collect your property tax for you, and there's always an adjustment. Good conversation to have with your lawyer. Did the previous owner make all his payments, or am I gonna have to cover the remainder of his 2013, and what's that gonna look like for me? So always prepare to ask your lawyer about the property taxes. Home inspection fee, yeah.
I'll talk about home.
Okay, we'll talk about Sam will talk about a home inspection fee. Again, service hookups, fire insurance. Lenders are always gonna want you to have insurance on the property, because if you move in and the next day it burns down and you don't have insurance, that is not a good position to be, okay? And then moving costs, obviously, guys. So Sam will get a little bit more into the closing costs or whatnot in the purchasing process. So the closing. We'll work closely with the client right through the closing date and beyond. So that means that I work hand in hand with you. I want to be involved in the process. I will be involved in the process. I'll be talking to your realtors, I'll be talking to your lawyers, and I'll be talking to you on a regular basis, okay? It is a process. We have to stay in touch. We'll assign the mortgage to the branch of their choice. If you guys live on the southwest side, the northwest side, or if you don't care, when we come to signing the mortgage, you let me know what is most convenient for you, and I will send you to that TD branch in particular, wherever it's most convenient for you. So I'll work with the branch of your choice. Everyone involved in the transaction is kept informed. That's my job and my mandate. Okay, so everyone's going to stay on touch and stay on base. And we will ensure a comfortable customer experience for everyone. That is obviously and ultimately what I want from my clients, is a beautiful, seamless process from beginning to end. Again, credit is never black and white. It's always gray. Every deal is different. Why choose TD Canada Trust? Here comes the corporate pitch. Okay, guys? So, bottom line, I focus solely on mortgage, real estate, or principal-related residential mortgage lending, should I say. Okay, so I can do residential mortgages up to 1 to 4 units. If you guys in the future are ever looking to build a property, maybe a duplex, live in one and sell the other, we can also do that. We do builder mortgages, we do refinances, we do everything. We understand the needs of your business, so if it's a little more of a complex deal, or I basically want to sit down and fully understand what's your motivation for purchasing the property, because that's going to dictate what kind of product and what kind of term you should take. Okay? I know everyone likes to quote the 5-year, what's your best 5-year rate? Tell me why you want the 5-year rate, right? That's a better question. Why are you looking for a 5-year term? If we discover in the meeting that, you know what, you're only going to be in Edmonton for 2 years, you shouldn't be looking at a 5-year rate. You should be looking at a 2-year fixed rate, or an open term, or a variable, an open floating rate mortgage, okay? We'll need your clients, I write here, we'll help your clients find the right mortgage solution to fit their best needs. That ties into having that conversation, okay? Discovering why you want to purchase, what your needs are, and tailoring the products to your needs. 120-day guarantee, some conditions apply, not really. We guarantee your rate. I don't know why I wrote that in there. Must have been for another presentation. But we will, once I book your rate, I will guarantee your fixed rate for 120 days from the time of booking. And here's the best part about booking the rate. Let's say I book the rate today. 2 months down the road, I give you a call. Hey, how's it going? Have you found a home? No, but you know, I'm still searching. Well, what I'll do is, if the rates are still the same, I'll rebook it from that date. And from that date, it holds for another 120 days, okay? So that's why it's good to stay in touch with your clients. How's it going? Have we found a home yet? No. Tell you what, the interest rates, we're starting to get to the end of the season where the banks traditionally start to raise the rates again. Let's book it and you're good for another 120 days. Okay. Competitive rates, obviously. TD, I gotta tell you guys, has some of the best back-end terms. So besides the interest rate, we've got great prepayment features, great portability features, Great flexibility features, miss a payment, skip a payment, pay vacation. I'm not gonna get into all of that now. That's something that I can elaborate one-on-one, okay, if you must know. But we have got very competitive rates, but I gotta tell you some of the most flexible mortgage features in the industry, okay? And full service branch solutions. I work for TD Canada Trust. I came from the banking and retail area. TD's whole mandate is to obviously, if we get your mortgage business, we would love to have your day-to-day business, your investment business, everything. All the banks want all your business. But the bottom line is, I've got all the branches and the TD network that I can use to my advantage. So even if you guys were in the middle of a mortgage deal today, and you guys were in Moncton, New Brunswick, and all of a sudden the deal closed and you needed to sign, I could send the documents to a TD branch in Moncton, you go in there, you sign, we're done. So you can leverage the scope that TD has. TD also has TD Bank North in the United States, but we actually have branches all along the Midwest and the Eastern Seaboard. So if you were ever down there and for any reason we needed a signature or documentation, or TD Ameritrade offices, I could send you guys into those offices and get your signatures on any documents that we need. Convenience, obviously TD prides itself on its convenience, longest hours. My service, guys, I don't work, so I just went a little bit longer than planned. I don't work 9 to 5, I work around the clock. So when it's busy for me, sometimes I'm going to bed at 4 in the morning because I got that much business and that many deadlines to meet. I can start at 7 in the morning, I can start at 3 p.m. The beauty of it is the flexibility to be able to meet your needs. If you can't meet me until 10 p.m. at night, I will meet you at 10 p.m. at night. Okay, that's the flexibility and that's the scope of my service. I am not 9 to 5, I am convenient for you, okay? Largest retail distribution network, again, we're across North America, so you can walk into one TD branch in Moncton, New Brunswick, or walk into one in Edmonton, it's the exact same thing. Documentation up front, I love working with documentation up front. That's my mandate, so I will prepare you and send you what you need. If we're going to meet together to do a mortgage application, I will send you a list of what you need so that we can get all inputs confirmed, income, down payment, everything. And award-winning service standards. TD, proud to report that TD is 9 years in a row. This is unprecedented, guys. JD Power and Associates, best in-class customer service, 9 years in a row. That's a testament to our mandate. That's a testament to our level of customer service. Nobody can touch us on customer service when it comes to retail banking, okay? And if some of you are TD clients here, most of them I know, you can attest to that, we kind of bend over backwards for the client. It's very nice and it earns a lot of business. All right, so minimum requirements for approval. I know this is a question that some of you guys had asked, so this is getting into some of the additional questions. How many of you here have permanent resident status and how many of you here have non-permanent resident status? So who's permanent resident here? Who has a PR card? Okay, so a few, so maybe about 1/3, and then the rest I'm assuming are temporary visas, student visas. Okay, so there are different down payment requirements and lending requirements when it comes to permanent versus non-permanent resident. Okay, minimum requirements for any credit application. Okay, this is not including permanent or non-permanent. Any credit application. This is a kid who turned 18 and just has new credit, or someone who's been 40 years old but never had a credit card in their life. Minimum 12 months of existing credit history. That is what most lenders are going to want to see. At least 12 months of a credit card, reporting and on-time payments, reporting on time. And I really, really hope that all your payments are on time within those 12 months. Because if there's a late payment in there, that's not good. Because we've only been reporting for 12 months and we already have a late payment. Okay? So keep that in mind. 12 months minimum credit history. So if you don't have a credit card right now, or any other credit product such as a loan, do yourself a favor and go get a credit card, a Canadian issued credit card, immediately, and start reporting credit history, okay? If you have friends coming from Iran or from overseas that are coming to the U of A, and they don't get a credit card right away, big mistake. Get a credit card right away. Not a big one, not a high limit, $500, good enough. You just want to start reporting to the credit bureau and start showing credit history immediately, okay? The longer the credit history, the more history there is to tell about the client altogether, and the better a judgment an underwriter can make. Provable and confirmable employment. Obviously, we've talked about the requirement. You need to be able to prove that you're employed or at least are generating an income. Okay? And credit in good standing. Very important to understand. Just basically make sure your payments are on time. Most credit card companies will offer a minimum payment or a full balance option. Well, they'll actually take out the minimum required payment in the event that you forget. They'll take it directly out of your account. I highly implore that you guys at a minimum opt for the minimum payment option. Because that way, I know times get busy, people get busy, and you think, I forgot to pay my credit card, right? Not good, okay? Make sure that the payment comes out like clockwork. You do that, and the underwriters are gonna love you, okay? Non-resident applicants. Okay, here's the big one I think everyone's waiting for. So, if I'm a non-resident in Canada, can I get a mortgage? Yes, you can. The minimum down payment is 10%, okay? This is for everyone who does not have a PR card. And I know that you can say, Leo, I'm applying for a P card or it's in the process. Doesn't matter. We want that PR. If you want to consider yourself as permanent resident, we need to see that PR card number. At the very minimum, that number. Okay, the card has to exist. It has to be issued to you. So 10% down payment. What if I haven't been here that long or I don't have credit history? Well, again, the minimum 12-month credit history will apply. We also need to show a qualified down payment. A lot of non-residents are going to get their parents or a family member to wire them over money. That's okay. Just be ready to expect that the lender is probably going to ask you to be able to trace that wire a little more. They're going to want to know who it came from, where the sources were. They may even go as far, depending on the situation, may even go as far as to ask for statements from the other bank showing a 30-day history of that bank account in another language. If it's in another language, they'll say, don't worry, we'll translate it. That is anti-money laundering legislation, guys, okay? That's out of our control. It's the government saying we need to confirm where this money's coming from. Support with international credit pool. If you have credit in another country, depending on the country, if it's a very well-established financial country, such as the UK and India, I know we do credit pools in India and whatnot, depending on how the reporting is done over there, we can do an international credit pool. So if you have very limited credit here, we can perhaps lean into your credit history over in another country, and that may support your credit application over here and your credit history over here. The easiest ones are obviously United States, UK, any kind of European countries. It gets a little touchier. Hang on, guys. It gets a little touchier when it comes to more developing countries. Okay, we may or may not accept credit reports from developing countries altogether. Support with a letter of reference from financial institution from your country of origin. So if you do have good credit history or good account standings at another institution, maybe prepare yourself or just say, hey, bank over in, Banco Central in Chile or whatever if you want. You can say to them, I need a letter from you stating my account is in good standing, how long I've been a client for, and that I'm a good client, right? I'm not in arrears, there's nothing due, and that my payments are usually on time. And most institutions will lend that. Anything that can support your viability as a borrower overseas, as a borrower over here, will only support the application, okay? So maybe prepare yourself to ask for a letter of, before you apply if you're a non-permanent resident, come into the bank and say, on top of that, I have an international credit pull, and I also have a letter of good standing from my financial institution. That will only support your chances of an approval, okay, for a mortgage product over here. At a minimum, a letter of reference from the landlord. So, if we go back to point 2, Leo, I just got credit 6 months ago. I'm just starting to report, I only have 6 months of reported history. Okay, what we can do is, have you been paying rent? Yes. Can you get me a letter from your landlord stating that you've been paying at least 12 months of consecutive rent and your rent has always been on time and you're in good standing with your landlord? If yes, get it. It can only support the deal. Any insurance payments to a company, if you've been paying insurance on time, any bill that you have that's been reporting or showing, get 12 months history showing that your bills have been paid on time, or a letter from the company stating that you've had this account open since 2010, 2011, that you're in good standing and all your payments in time. Again, anything that can support your viability as a borrower or someone who pays their bills on time will only support the deal, okay? And proof of 12 months consecutive payments. So that's that last point that I made there. Permanent resident status. You show me that PR card and you can get minimum 5% down payment. Again, we're going to have the credit minimums. Like, all lenders want to see at least 12 months minimum reported history. If we cannot support those 12 months, what are we going to get, guys? Letters of good standing, letters from companies, insurance companies, cell phones saying that you've been paying on time and how long you've had that account open for, okay? The key is we're trying to hit at least at a minimum 12 months of on-time payments from any source. That is what most lenders are going to want to see. And pretty much, yeah, qualified down payment. Pretty much the same thing, except the key part there is 5% down payment as soon as you have that permanent residency card, okay? Step one, decision time.
That's me.
That's you. And that's my presentation, guys. And I know they got one. Thank you for your time. We're going to leave a lot of Q&A time, so I'm going to pass it over to Mr. Stan Ashton here, guys. No? Yeah, you're pretty loud anyway, so.
I'm loud enough, so. Actually,
Sorry. Yeah, sure.
all right, guys, I'll keep it short and sweet, because I know you're all busy. My name is Sam Hashem, and I've been a realtor for over 10 years. I am the author of that book in front of you, Real Estate Simplified. It took me 2 years to write it. I published it 5 years ago, and it's very authentic. It's the first and only real estate book ever written and published in Edmonton, in Alberta for that matter. So I really hope you guys take the time to go through it. Today I'm just going to go through just section 1 of the book, which talks about first-time home buyers. But before I do that, I have a quick story I want to share with all of you. I was 22 years old, and I had recently got my real estate license, and I thought to myself, man, wouldn't it be a great idea for myself to buy my first property? And at this time, I didn't know very much about real estate. Honestly, I was just starting out. I had no idea about lawyer fees and closing costs and all these things. So by the time I put an offer on the place that I was buying, and I had to go and sign with the lawyers, I was about $2,000 short of the money that I needed to close on the deal. So I had to make that call to my dad. And I know some of you know how ethnic parents can be at times. And he was not too happy with me. But you know what, at the end of the day, I just chalked it up as a learning experience. And I said, you know what, when I get a little bit more experience in real estate and I start helping more and more clients, one of the things I'm going to really focus on is helping them prepare for the costs that are incurred with buying their very first home. So I'll start real quick here. This is a presentation that I give every once in a while. I haven't given it in a long time, but I'll start with step 1, which is decision time. Okay? Are you in a position to buy a home? Do you have a stable job? Do you feel that you can take on the responsibility of a mortgage? Mortgage is something where when you sign into it, that's it. You're on the hook, right? And you have to make your payments. You miss your payments, you're in a lot of trouble. Now, what banks normally do, if you miss a payment or 2 payments, 3 payments in a row, you know, they're not that harsh on you. And I know maybe Leo can agree with me on this.
There's some flexibility. There's some flexibility pending.
I know people that have gone maybe 6 months without receiving anything from the bank, and then all of a sudden they see a guy at their door, and he's got the sheriff's hat on, and he's presenting them with papers saying your house is being foreclosed on. So the banks are generally really good at being patient. Now, I'm not here to suggest that you go off and start missing payments, but what I am going to tell you is that when you do, if you are ever in a position where you're going to miss a payment or whatnot, I mean, I wouldn't lose any sleep over it. And I think TD has a program where you guys can skip a payment, right?
Skip a payment plan, yeah.
Yes. And I think, are you the only bank that does that?
Yes.
Yes.
Well, the only
They're
bank
the first bank that did it. I remember that. I remember that. So if you feel that you're responsible enough and your job is stable enough to have a mortgage and be able to pay a mortgage, then that's one of the humps you got to get over when you're first looking to buy a home. Now, are you prepared to invest money into that property? Are you looking for something newer? Are you looking for something older where you can maybe create a little bit of sweat equity? Now, what sweat equity is, I don't know if you guys have ever heard that term. It is when you buy a property at a lower cost and you put your own work into it, your own money into it to get it back to that certain level of value. For example, if a house is worth $350,000 and you're buying it for $300,000, but you know you're going to have to put $25,000 into it, well, you can do that, buy the house, get access to that $25,000 to put back into the house. All of a sudden, boom, your house is worth $350,000. It really cost you $325,000 to get it, right? But are you prepared to take on that headache? For some people it's a headache, for some people it isn't, right? So that's one of the things you got to think about when you're going into it. Do you want to be in a new house? Do you want to be in an older house? And do you expect to live in the same city, town, or area for the foreseeable future? Now, I think I spoke to somebody earlier tonight that was asking about, you know, if they bought a condo and they moved away. I always think it's a great idea to buy a home, no matter what situation you're in terms of your job, because if you are with a good company, generally, and a lot of times, they'll pay the moving costs. So if you take a job next year with one of these big engineering firms or whatever, whatever you guys are going into, and 2 or 3 years down the road they say, oh, we're going to transfer you to Calgary or Toronto or wherever, but we're going to pay the cost of you selling your house and moving and all that stuff, then really you're safe, right? So you don't really have much to worry about. A lot of good companies, if they really like you and if they want to treat you well and they want you to work for them for a long time, they'll cover that. So you should keep that in mind when you go through the interview process as to, or you can even ask them, okay, if you guys ever transfer me, are you going to cover this? Right? It's a very important question, and they'll definitely be happy to answer it for you. So, on to step 2. Now your mortgage situation, Mr. Leo already touched on that for his time up here, so I'm not going to go into any of this at this point. So yeah, just go on to step 3. Total upfront costs. All right, now this is an interesting one. This is the one that got me hooked when I was 22 years old and my dad got mad at me. So I really have to be able to explain this to you guys properly. Now your down payment, obviously Leo went over that and what you would need to come up in down payment. Lawyer fees, nowadays you're looking at spending between maybe $1,200 to $1,500, $1,600, okay? The actual lawyer fee that they take usually is about $700, $800, $900. And above that is all the administration costs and their anything to do with the administration costs on it, all right? Now, you have to be prepared to have that money aside when you go to close, because the lawyer is going to ask you to bring in your down payment money plus their fee. Now, if their fee is going to be around $1,300, $1,400, they're going to ask you to bring in an extra $1,600, $1,700 just to cover in case there's any extra costs incurred. Tax adjustments. Okay, property taxes you have to pay. They are due on the 30th of June every year. Now most people these days, they pay their property taxes with their mortgage on a monthly basis. So if your property taxes are $2,400 a year, for example, on June 30th you're paying that $2,400 to the city, or you're paying $200 a month with your mortgage. Okay, so now if you buy a house from someone who pays it yearly, and you take possession, let's say for example, March 30th, okay? You take possession March 30th, now they haven't paid the, oh, by the way, sorry, June 30th it's due, you're paying 6 months arrears and 6 months ahead, okay? If you take possession March 30th of that year, then when you take possession, before you take possession, the seller is gonna owe you that 3 months worth of property taxes. So they'll owe you the $600 on closing. So that's very important that you have a good lawyer in place that looks into that. Otherwise, that extra $600, you're going to be on the hook for it. And I've seen it happen where lawyers have missed it. And it's not fun. $600 is a lot of money.
It adjusts your monthly payment, and sometimes it's a surprise over and above your fixed payment, right? So very important point, guys. Talk that with your lawyer.
There's no land transfer taxes here. Land registration fees at land title, $100, $200. Land transfer tax, as Leo mentioned, in Ontario and BC could be anywhere up to 1% total purchase price of the home. We're very lucky to be here in Alberta. Like I said, no PST, and we have a lot of advantages here. So that's not something to worry about. Title insurance, this is something that's interesting. Okay, if you're buying a house, with that house, you get, the seller has to provide you with what's called a real property report. Okay? Now a real property report, it outlines where the house situates on the property and any other buildings on the property, such as a garage. Okay? Now, if that garage is built too close to city property, or if there's anything on that property that encroaches onto city land, if you buy the title insurance, which costs about $200, you're covering yourself against that. So at any time, the city might come to you and say, you have to take down that garage because it encroaches onto our land and we need that land for whatever. Now, title insurance is very important. That's something that your lawyer should talk to you about, or you should ask your lawyer about, because you don't want to be in a position where you buy a house and there's something on the property that's built onto the property that's going to cost you extra money. I had this one couple one time. They bought a house in the east side, and they had a retaining wall around the front yard. They had a corner lot that had a retaining wall around the front of their property. Now, the problem with that retaining wall was that it was too close to the sidewalk. And when we went to lawyers, the lawyers they wanted the sellers to pay $20,000 to the city because the retaining wall was encroaching onto their land. And that was a huge headache. Imagine you're a property owner for 20 years. These guys were old people. They were retiring. No mortgage on the house, selling it for about $400,000, and then all of a sudden they get this notice from the city that they got to take down this retaining wall or pay 20 grand. At the end of the day, we fixed it so that the buyer took on that retaining wall, and they took the house, and they said, if we ever sell the house, we'll just not have that problem. But having a call from a lawyer with a problem like that is not the funnest thing in the world, trust me. 20 grand is a lot more than 600 bucks, right?
Sam, can I answer that really quick? Sorry guys, another thing too that we'll see as lenders on land titles is any lien against a property can be registered on land titles. So if there was someone who had done work for the previous seller before they had sold the home and the seller had not paid them, they could register a lien against that property, which is legally encroaching. So if you're unaware of that as a buyer and you make that purchase on that property, guess what? And you take title of that property, you've now inherited that lien. And that lien can be actually issued against you in the court of law. So what title insurance will essentially do is if you take that $200 insurance, it'll make sure that any liens, any encroachments that previous owners had, they'll take care of it through the insurance premium itself. So it's an insurance against any of those issues. There's a variety of things that can happen on titles, guys. We're not trying to scare you, but it's something you need to be aware of when you're purchasing a property, okay? So go on.
The person you're dealing with, the realtor you're dealing with, and I deal with these issues all the time. I always make sure to answer all these questions, anybody that would help them to buy a house. Because if you don't know about these things going forward, you're going to have a lot of headaches coming out of it. And that's the last thing you want to do, especially with a purchase like this, because for most of us, you buying your home is the biggest financial purchase you're going to make in your life. Property insurance, I know Leo touched on it earlier, $700, $800, $900 a year, and you're going to have to take it before you possess the property. So let's say you have a possession coming up on August 15th, and you're going today to sign with the lawyers. Your lawyer's going to ask you for your insurance binding paper, okay, showing that you have purchased insurance for the property. If you don't get that, if you don't call your insurance company and say, hey, I want insurance on this house that I'm buying, you're not going to be able to possess the property on time. So that's very important, and I'm sure your lawyer, if you have a good lawyer, they're going to remind you of that. Home appraisal. Now, I know with TD it's a little bit different. Now, sometimes you go to a private broker and they want you to pay for the home appraisal when you're trying to qualify for the home. So they say, okay, you have this home you want to buy. Okay, good. We're going to do the mortgage for you, but we need to do an appraisal. Appraisal costs $400. You got to pay $400 for an appraisal where a bank like TD. What do you guys do?
For us?
You guys pay for it?
Yeah, through me. If it's in Alberta, then I can get your appraisal covered for you. If it's outside of Alberta, then I can't cover the appraisal. So sorry, I should have said, one of the advantages of dealing with myself and my channel is I'm a whiz at getting the branch to each appraisal costs. And that traditionally is around $300 for a full appraisal. That's with the bank covering half the cost, and $200 for a drive-by appraisal.
Moving costs is another thing that would be, depending on how many friends you have and what you're looking to pay. Now, home inspection. Home inspection, if you could get to the next slide here. Yes, home inspection is something that's probably going to be the biggest make or break of this whole transaction for you, okay? I always recommend people to get a home inspection. You're buying a house, no matter how old it is, whether it's built in 2013 or built in 1953, get a home inspection. $500 is a drop in the bucket for $500,000 you're going to pay for that house that might give you problems if you don't get it checked before you take it. When I first started in my first year, I had this one couple. They were buying a house, and this is 2004. The house they were buying was built in 2002. So we booked an inspection, and we were going in to inspect the house. And I thought, you know what, man, this is going to be a piece of cake. The house was built 2 years ago, no problem. We go through the whole house, still no problem. We get upstairs to the ensuite bathroom in the master bedroom, and the home inspector takes what's called a moisture meter. Okay. Now, what a moisture meter does, you put it up against the wall, and it detects any moisture behind the walls. So he takes the moisture meter up to the bathroom, up to the ensuite bathroom, puts it through, and the light goes red all the way. There's moisture all behind the walls. The house was built 2 years before that. Now, moisture can create a lot bigger problems, right? Because you have that house now, there's a little bit of moisture issue, okay, maybe no problem, maybe no health risk, right? But moisture can turn into mold. And if your house has a mold problem, then you got real problems. Because all of a sudden now it becomes a health risk. And it costs a lot of money to get rid of mold out of the house. Even if the house has had mold before, you always got to be conscious of the fact that, you know, maybe you didn't get it all up. I mean, yeah, we can get rid of the mold out of your house, but can you find one that'll absolutely guarantee you that it won't come back? 10 years in this business, and I haven't seen it. Get a home inspection. No matter what the cost, no matter how old the house is, you want to make sure that this investment that you're taking is the right investment. And there's not going to be any issues when you take over the house. Now, when you do this, when you're out selecting a company, you got to look for these companies that have inspection guarantees. Okay, now there's not too many companies that do have that. All right, and what they do is they guarantee their service. I think one of them, for example, is Housemaster. They guarantee their inspection for up to like 120 days after the inspection is done. So if they screwed up somewhere, or if they missed something, they have the insurance to cover it, right? So if they missed a broken pipe in the basement, you take possession, 10 days later, pipe bursts, and you got a water issue in your basement. Well, if they have the insurance, they'll cover it. Formally trained and certified inspectors. Now, there's a lot of home inspectors out there. There's a lot. There's a lot of home inspectors that are good, and there's even more that are not good. You know, you got these guys that will charge $300, $350, but are they really going to do a good enough job for you? Maybe, maybe not. But maybe, maybe not is not good enough. It's not good enough for me. And I know it's not going to be good enough for you. And I know real estate. I've been in thousands of houses in my career. Thousands of houses. And still, to this day, if I'm buying a house today, I am getting a home inspection. No doubt. No doubt. No doubt. Reputation of the company that you choose is very important. You know, it's important to do some background check. Ask your realtor. It's something that, with anything else you buy, right? You're going to buy a Honda, or what's an example of a bad car?
Hyundai, I think.
Hyundai?
Not so much
No,
now.
I have a Hyundai.
I don't know. An old Lada.
Okay, I don't even know what that is. But it's the same thing, right? I mean, you want to buy a car that has a good reputation. You're not going to go to a company that has, you know, a reputation of car breaking down after the first year you buy it, right? I think I talked a little bit about the insurance already. The inspection report, you know, they'll provide you, you do an inspection, they'll provide you with a good inspection report, and you know, it should outline everything. And one of the things I would ask the company that you're going to choose is that, can you show us an example of a home inspection report that you have? okay? And I always recommend people any buyers, to go through one of these reputable companies. I had a guy, a good friend of mine, he bought this one house a couple of years ago. He never used me, but he called me when he needed to sell it. So I went and saw him, and I saw the house, and it had all these problems. So I asked him, I said, did you get an inspection on this house when you bought it with your whatever realtor you used? And he said, yeah, I did. I got an inspection. I'll show it to you. He comes back to the kitchen table, and he's got 10 measly pages of an inspection report that I thought was absolute garbage. Because an inspection report should be at least 40, 50, 60 pages, and it's got to run through the electrical, the plumbing, the roof, structure of the house. There's so many things that an inspector should look for you, because you're paying $400 or $500. He paid, I think, $320 for that inspection. And I told him, you know what, I don't want to make you feel bad, but you might as well just burn that money. Because whoever did the inspection did not know what the heck they were doing. All right? We sold that house, and he lost $55,000 on that house. He bought it for $360, and the maximum dollar we can get for it was $305, because the people that bought that house from him, they got an inspection done, but they used a reputable company. And they were able to get the deal that they wanted, because we had a particular price set already. They went and did the inspection, found all the problems, so they decided to come back and renegotiate. So sometimes when you get an inspection, and I'm not saying all the time, but sometimes you get an inspection, it gives you that opportunity to come back and renegotiate. I just had a guy about a month and a half ago. I sold him a house on the West End. The house, we had it for, I think it was $420,000. We went and did the inspection, found a few minor problems. And he paid $500 for the inspection. After the inspection, asked for $10,000 off the price. 10 grand. Didn't get it though. But they gave us $5,000 off the price. So really, after doing the inspection, he saved himself $4,500 off the price. Right? So you get a proper inspection from a reputable company, you'll get that money back. Whether it's today, whether it's 10, 20 years from now, you will always get that money back.
Best money you ever spent, to tell you the truth. For the grand scheme of things, you just want to make sure that what you're buying is solid. And I got to tell you, I've seen it time and time again what you're talking about. People always come back. If there's an issue, you can renegotiate the price, and it may even be to your advantage, right?
Yeah.
At the end of the day.
Yeah, definitely. And I encourage you guys to ask me any questions about this particular portion of this after, because as you can see, I'm very passionate about it. Maybe you don't notice, but. All right, step 5, hiring a lawyer. If you're buying a house, the seller has to provide the real property report, which shows the outline of the house and any buildings on it. Obviously, I talked a little bit about that earlier. You're buying a condo or an apartment condo or a townhouse. The seller has to provide you with an estoppel certificate. Now, what the estoppel certificate is it's a document that shows that there isn't any liens against the condo board or anything, any money owing or any condo fees that haven't been paid yet. All right? And I'm going to get into that in a second. Lawyer has to provide you with a cost sheet of exactly where your money is going, like how much they're paying on the photocopies, what they're paying on the admin cost, on the land registration fee, timing and closing day. They're the ones that send the money over on possession day. So on the day you're supposed to get possession, which should be about noon, and I'll go over this in a second, on the day you're supposed to get possession, what they do on that morning is they send all the money over to the seller's lawyer, and once the seller's lawyer receives the money, they say, okay, you can give the key to the buyer. Step 6. Now, before I get into step 6, I just want to mention something about condos versus houses, because I know some people would prefer a house, some people would prefer a condo, and there's pros and cons to each. It all depends on what you prefer for your lifestyle, right? But there's one question that's been posed to me a lot recently, and that's to do with condos and assessments. Has anybody ever heard that term, assessments, when it comes to condos? No? Okay. Let's say you own a condo in a building downtown, all right? And the condo fees are $400 a month, and there's a reserve fund. With every condo board has to have a reserve fund. Let's say there's a reserve fund of $1 million, and next year you have to do all the windows and the doors and the roof and the exterior, and there's a bunch of work that needs to get done. And let's say it's about $3 or $4 million worth of work that needs to get done. Where is that excess money going to come from? It's going to come from the owners. All right. A friend of mine owned a condo on Saskatchewan Drive over here, and every unit got levied or assessed $25,000.
High level crossing?
Huh?
High level crossing?
Water's Edge.
Water's Edge, yeah.
Every owner got assessed $25,000, and they had to pay that $25,000 towards the fix-ups of the condo. Now, if you don't pay that, if you refuse to pay that, the condo board can foreclose on your property and take your property. So when it comes to buying condos, the only thing I can suggest, number one, is to review the condo documents to make sure that there is enough money in the reserve fund to cover any potential costs that are coming within the next 5 to 10 years. Now, generally on buildings like that, every 25 to 30 years you're going to have to do everything on them, right? Windows, doors, roofing, siding, and all that stuff. So if it is a condo that's been managed properly, you're not going to have a problem. But if it hasn't been managed properly, then you're going to have a lot of headaches. And that's one thing that I do with all my clients is I make sure that okay, you want to buy condo X right here. Okay, great. Well, let's go through the condo documents. Let's find out what's going on with the condo, what fixes they need, how they've been managed. Is the management company that they've hired, are they reputable? Are they good? Or are they just there to take the money? All right? There's a lot of factors that go into buying a condo, a lot more than buying a house, right? Condos are a great investment. Any property is a great investment. But doing your due diligence and understanding what you're getting into before you get into it is extremely important. Finding the right home. How much space do I need? Yard, garage, number of bedrooms, what area I want to be in, proximity to schools. The proximity to schools, if you guys are just starting out, you want to buy your first house and you're looking to get married, start having kids, well, you need to understand a little something about proximity to schools, because some areas of the city, I have a lot of friends of mine that live in Windermere. Right, you guys familiar with that area? Southwest, brand new area. A lot of friends of mine moved into that area. Got married, have kids. Big problem. There's no schools in that area. Where are they going to go? So they moved into this nice area, but they got no schools. So you need to understand going into it. I mean, there's a lot of great areas in the city, but if you're going to look to start a family and have kids and send them to school, some of these brand new areas, they're not going to have schools ready for 5 to 10 years, even more, right? So proximity to schools and amenities and all that is very important. And it does affect value too, right? Because people move into these areas expecting the school to be up within 2 years. All of a sudden you see 50 for sale signs the year after the houses go up. Do you want to be close to family or far away from family? That's a big thing. My older brother, Ali, he bought his first house. The house, this is before I got into real estate, the house next door to my family's house went up for sale. And my brother Ali comes home and he's like, Sam, I'm going to buy the house next door. And I said, man, are you crazy? You're right next door. But that's what he wanted to do. He wanted to buy the house next door to my parents. And this is 12 years later, and he still lives in that house. Him and his wife and his kids. And they got a free babysitter with my mom all the time, so they're happy. So there is pros and cons to that. But I mean, that's something that you got to decide going into it, because I guess some people don't want to be too close to family, I guess. I mean, I love my family to death, don't get me wrong, but I can't be that close. Anyway, step 7, using a realtor service. So, like you guys all know, I'm a realtor, and I help people buy and sell homes. We incur all liability, all right? If something goes wrong throughout the process, at some point, I'll incur the liability, of course. We have our own insurance and all that, so... all right, I got a story for you guys. If you want to hear it. You guys want to hear a story or no? I like the excitement. Okay, I was at a friend's house. I was selling my friend's house about 3 months ago, and his little brother comes over and he tells me this like completely completely scary story about the condo that he had bought. He bought a condo downtown that had a titled parking stall. Okay, so he owned the condo unit, it was in an apartment condo, and he also owned the parking stall. And then about 6 months ago, he comes home, and there was a note on his car saying, "Excuse me, you're parked in my parking stall, you have to move your car." So he goes and calls the realtor that he used, and he tells him, he said, "Look, somebody's, put this note on my car, and they say I don't own the stall." Well, it turned out what happened, the guy, or the realtor that he was dealing with, did not put the titled parking stall on the contract. So in essence, he never purchased the parking stall. And the owner, the previous owner, found out about this, and instead of being a nice person and actually being honest about it, there's not, it's unfortunate, he went and sold the parking stall to somebody else for, I think, $20,000. It was worth $15,000. He sold it for $20,000 to somebody else. So now this gentleman, he's my friend's brother, he's hooked, he doesn't know what to do. So he calls the real estate board, and the real estate board, it's under the errors and omissions, so they're able to cover it. So what they did, they had to spend $25,000, and they bought that parking stall back from the new guy that bought it, and they gave it back to the owner, my friend's brother. So he got his situation rectified. And it's very, very, I can't imagine the headache. You come home and you find out your parking stall belongs to somebody else. But that's just one example of the liability that we take on as realtors, because if you were to buy it privately, then he'd be out of luck, right? So, actually, end of the story is now the real estate board is suing that guy for $30,000. I hope they get it. We'll see. We're under a code of ethics. So there's rules and regulations that we have to abide by and we have to follow. Experience, if you're going to deal with somebody, you want to make sure that they've been in the business at least 5 years. And we do have access to needed professions, so we can definitely refer you to lawyers, home inspection services, insurance companies, and all that. And using a realtor is a free service when you're buying. The way we make money is if a house is for sale, the sellers offer commissions to the realtors that bring buyers. Okay, so it's a free service to anybody that's buying. So in my point of view, it's almost a no-brainer when you're looking to buy a house and you're getting a free service with full liability coverage. It makes more sense than anything. Step 8. I'll hurry up here. The home search. Obviously, we have realtor.ca. Which is our website that we have all the listings on. Newspapers, people don't really look at newspapers that much. Real estate magazines, they're always outdated. You see those Homes and Land and all that stuff. Most of those houses are already sold by the time they go to print anyway. So we're in a now society, right? This isn't 30 years ago where a house goes for sale, you got to go to the real estate office and they book you an appointment for next week to see the house, right? I get somebody that wants to see a house. When do you want to see it? Today? Okay, let's go right now. Because houses come and go, and all the best houses, when they go for sale, they sell right away. No matter how hot the market is or how slow the market is here in Edmonton or in Alberta, if a house is well priced and it's in good shape, chances are within 1 week it's gone. Neighborhood for sale signs, like I said, that's how my brother bought his house. So, like I said, he's happy, so I don't want to go into that. Step 9, making an offer. We don't have time today, but at some point maybe we'll email you guys out, or if you guys have questions, we'll get you an example copy of the purchase contract, kind of like the bill of sale. It's very complicated and it's very long and drawn out. But the one thing I can say is that anybody, when you're looking to buy a house and you want to make an offer, read through the whole thing. No matter if it takes you 5 minutes or 5 hours. Read through all of it, ask your realtor all the questions you need. Deposit, you always have to put a deposit when you're buying a home. Just like when you go to buy a car, they ask for your deposit. Usually at least $1,000 you have to have up front. Chateaus, most houses, they come with appliances, fridge, stove, washer, dryer, all that stuff.
Anything non-permanent, appliances, something that's not part of the structure is considered a chattel.
Condition day, usually allow 5 to 7 business days for condition day. So you write an offer, subject to financing, subject to home inspection. Today's what, August 12th? So if you write an offer today on something, then August 22. Give me till August 22 to get my financing straight and to do my inspection, and then the possession. One more slide, guys. Step 10, the big day, your possession day. Usually it happens around noon. You know, and as I said before, that's when your lawyer sends all the money to the seller's lawyer, and they have once they have the money in place, then that's it. You can have your keys. Make sure, this last major point, make sure the home is in the same condition as it was when the offer was made. All right. I've walked into houses before where there's been some damage done, and believe you me, it's not the funnest thing to go through when you're in pretty much one of the happiest days of your life. But when you do that, you make sure you do the walkthrough, and if there is any problems, talk to your realtor. If your realtor is a good realtor, they will handle it. Anyway, that's all I have to say here for now. Sorry, guys, I went a little bit over, but as you can tell, I'm really passionate about real estate, and I really hope that all you guys become property owners eventually and make lots and lots of money. Thank you.
Q&A time? Or?
Yeah, thank you very much for the lecture. As I said, this was the 17th session in our series. Our longest was 1 hour and 48 minutes, and you were 1 hour and 49 minutes. So.
Oh, look at that guy. Sorry, so I guess I kind of misjudged the time that it would take to go over those
but
points.
Thank you, it was very informative, and now we have some time for Q&A, but we can leave more questions when we end the session officially. But you
Can I say something real quick? Yeah, if you guys have questions now, and if you guys have questions for after, I'm going to stick around as well after. So, I mean, if you want to ask questions.
Me and Stan will be around for a while, guys. We got nothing better to do than talk about real estate and financing. Also, guys, we have our business cards, the books over there, whatnot, and our business cards in there. Feel free to grab one. Guys, if you have any questions or concerns, that's what we do. We answer questions. If you're not ready to buy today, one of the best things to do is ask questions today, so when you're all ready to buy tomorrow, you're well prepared. Okay, no surprises, no anything. You're going in there educated. So, any questions, guys? More than free to go ahead and ask.
Go ahead.
Thanks for a great speech, both of you. Which one's better option, home builders or like already built homes? Like in terms of price and like.
Home builders or pre-built, like pre-owned homes?
Yes.
It really all depends. I'd say from my end, what I see from the financing side is in terms of price, you're always going to get quality and you're going to get modern with a home builder, which is a brand new built home, right?
More expensive.
It can be. For example, I don't know, Sandy, you might attest to this. In the center of the city, if you get an older home, your property taxes are higher, and because the fact that the property is located it's centrally, you have quick access to downtown, quick access to the U of A. Sometimes you're not going to get a newer house, but it might actually be more expensive than a brand new built home on the edge of the city. Right?
Pre-built homes, all the way. If you're a first-time home buyer, all the way. It's a lot cheaper because you're buying a brand new home that's going to be built. You're still going to be on the hook for landscaping costs, putting up fences, putting up garage if it's one of those ones with the garage in the back. There's a lot more expenses. I've been in both scenarios. You know, I've bought pre-built homes, and one time I did buy a house that was built by a builder, and I found that my costs were a lot more with that. Now, if it's your second or third property, then yeah, for sure. I mean, you know, if you want to get something built, then yeah, definitely look at that option.
With your own design.
Huh?
With your own design, like if you want to like have like 2 or 3 rooms upstairs.
Correct.
Yeah. But the thing is that sometimes, with a builder, not everything will end up as you kind of envision. And as a first-time home buyer, you don't really want that shock to find out that, oh man, this happened or that happened or whatnot. So my first home was a pre-built home, and you know, it was an older house, but I was happy with it, and you know, I made money and I moved on to something else. So that's my recommendation. But I mean, you know, whatever your taste feeds you is what you like. So I hope that answers your question.
Yeah, it does.
Any other questions, guys? Open it up, guys. Don't be scared. That's what we're here for. Go ahead.
I think Leo, you can answer this question. I have a question regarding this. Okay, you were talking about down payment 5%, 20%. I heard from some of my friends that usually for a down payment, for the first 5 years when you're moving to Canada, they, as a kind of incentive, you can pay as much as just 5%, even if you're not in the PR. Is it correct?
So when you're doing anything less than 20%, you have to take CMHC insurance.
Okay.
When you take CMHC insurance, that means there's two underwriters underwriting. There's the institution lending you the money, and then there's the insurer underwriting. It doesn't matter what the institution lending you the money says. If the insurer does not approve or you do not meet the insurer's guidelines, then you will not get approved for the insurance premium. So there's new to Canada. If you guys want, if anybody's interested, by the way, too, we're going to send Ali both our contact information. This is probably one of the most common questions I get, especially for non-permanent resident clients, is what do I need and how can I, what is the minimum that I can get for a down payment? CMHC states that if you want an insured property, new to Canada, non-permanent resident, 10% down. Have I snuck people in? Because the underwriter didn't catch it and neither did the insurer. Yes, it happens rarely. Sometimes they say, what the hell, let's just shoot it in anyways. The worst that can happen is they can say no. For example, I get a guy who's an English, funny story. Just finished a hard work week, cracking a beer, Friday, checking all my emails. I get a condition removal. So when you remove conditions from a mortgage, from an offer to purchase, that means you are now in a firm contract. You are buying this property. Okay, you signed off that I've got my financing and I've removed my inspection condition. This is a firm sale. That means that no matter what, you are now buying this property. Okay. He's sending me his condition removal form. At the same time, he says, by the way, I'm not a Canadian citizen. And we only had 5% down. Now, Canadian citizen doesn't necessarily mean non-permanent resident, right? So that I cross my fingers, literally sitting on my couch with a beer, be like, right? So I'm like, cross my fingers, I'm like, okay, at least he's got his PR card. So I emailed him, I said, do you have your PR card? No. Panic mode. Because immediately I'm thinking, if anybody catches on to this, the lender catches on, my institution, for example, we're not gonna have an approval, and this guy just removed his conditions. So lo and behold, I ran to the branch and made sure they get approved for an additional 5% down, because you can borrow over and above your first 5. You can borrow it as long as you can service the debt altogether. Bottom line, it snuck through. Nobody was the wiser, and he's a non-permanent resident, and he came down with 5%. But typically, CMHC, new to Canada information, if you guys want, you can email Ali, and then I can email you, or you can email me directly. I will email you the CMHC handout that shows you exactly what the insurer needs, CMHC needs, in order to qualify for a high-ratio mortgage.
So like what can happen, so it's legal?
It can happen. It's not CMHC's mandate, though. Right? Their mandate is 10% down. They can do it. You have to, again, credit is not black and white. You have to show the strength of the application. So if the client is coming in with, well, traditionally, if you got your down payment, very high income, for example, right? Very, very good or long credit history. They may have had credit in Canada for 5 or 6 years, but they don't have a permanent residency status. The fear of non-permanent resident application is this. If I'm a non-permanent resident, I can up and leave this country like that. There are no ties, there are no legal ramifications. I am not a resident of this country. So the banks want you to have a little more, the lenders want you to have a little more skin in the game, for lack of a better term, in your purchase, so that they're more comfortable lending to you, right? Once you become permanent resident, boom, automatic 5%. So yes, it is possible. How often do those applications actually get approved? It's very seldom. That's the problem that we're all complaining, because CMHC came out with their new to Canada policy, and it really hasn't changed all that much, right, from their previous policy. So I just got a question here.
So does the mortgage term depend, does it change if you're not a resident?
Not at all. So the terms are the same, amortization rules are the same, everything's the same. The only real difference between permanent and non-permanent is the amount of down payment that the banks and the insurer requires you to put down. And traditionally, expect 10%. Set yourself with that expectation. You can ask your lender to ask for 5. It's not impossible to get approved for just 5, but you really, really have to give me some information to strengthen the deal, right? I'm gonna start asking for letters of reference. I'm gonna start asking for as much history of payments and good payments in good standing, accounts in good standing as possible. Basically get that approved. Question?
So does this mean that if someone pays down 20%, does it need to get the CMHC insurance?
CMHC is gone. They're not involved anymore. So you don't pay the premium, we don't send the deal to them to be underwritten, and you get to amortize over 30 years. So that's why the 20% is such a magical number, guys. Everyone always tries to say put 20% down, because those 3 factors apply, especially for non-permanent residents. As soon as you put 20% down, the insurer is not a factor anymore, by law. We don't have to take CMHC. Here's a good example. Rental properties. People who want to purchase a property for the specifics of renting it out and generating into an income earning property, lots of people are doing that right now. If you guys have seen the stats, have you guys noticed, are you guys renting around White Ave, or a lot of you renting around, have you guys noticed your rent going up year after year? You know why that's happening? Because oil prices are spiking. When oil prices spike in Alberta, lots of production, lots of migrants, workers that come in here, people from Ontario, people from BC come into work to capitalize on the income. What happens to rental vacancy rates? Vacancy rates drop because there's not enough supply of rental properties. So thus, what happens? Oh, I got like 5 people banging on my door to rent this place. Maybe I'm gonna jack the rent up. So that's what renters do. What people don't realize in Alberta, and everyone keeps on trying to buy rental properties, is oil prices take a significant flatline for a while there. Guess what? Production drops. Guess what? All your renters leave the province. And now you're stuck there trying to find a decent renter for your $1,200–1,300 a month mortgage payment, and then you're going to start doing risky things. If there's not enough renters out there, you're going to start doing risky things like letting that 21-year-old pothead move into your house. God knows if he's going to start selling dope out of your house or building it or whatever the case may be, and that's where people get into an issue with renters. But to get back to your question, renters usually require at a minimum 75% down to get a rental property. You can do up to 80% or only 20% down, but then CMHC will be required. So for rental properties, 75% no CMHC, 80% CMHC, right? For personal owner occupied, 20%. That's what you have to remember. For my own place, as long as I have 20% down, no CMHC involved, which is quite nice. No premiums, maximum 30-year amortization. Any other questions, guys? Let them rip. Yeah, go ahead.
Next question regarding the transferring the ownership. For example, you got a mortgage on your home, okay, and after a couple of years, 3 years, you're going to sell your property. Okay, one of the big issue here is how you want to transfer the mortgage to another person. Is it possible to do so or not?
So you're talking about assignment of the mortgage. So I don't want to necessarily pay a penalty. I want someone to kind of slide into this debt product in this house, right? So then I'm out. Okay. So that's called a mortgage assignment. Okay. You can assign a mortgage as long as there is more than 6 months left on the term. That's TD's policy. Okay. That's pretty standard. So as long as you have more, 7 months remaining, great. It qualifies for an assignment. 6 months or less, cannot assign the mortgage. Okay. The client who's going to bring in the mortgage, the terms have to stay the same. The interest rate is the same. The amortization is the same. The payments are the same. Everything is the same. The client who's coming in must qualify under those terms. If they qualify under those terms, that's actually a great question, because that's how you can actually get out of a mortgage agreement without having to pay a penalty. So basically saying, hey TD, I found someone else to basically take my position on this product in this house. Here you go, we qualify, we transfer over, there's a legal cost to it because we have to change the registration. We can usually do it at solicitor instructed, so you will have to hire a lawyer to do the assignment. That'll cost you anywhere again from $1,200 to $1,600, but it is possible. And that way you can actually get out of the product without paying a penalty. Did anyone ask me about a port? How do I move the mortgage? I was surprised no one asked me about how to port a mortgage. So what are my options if I take a 5-year term? Let's say, for example, I plan on living in this home for 5 years, but guess what? I get a great job offer in Lethbridge. These guys are offering me $140K a year. I can't miss it, right? It's a great job. It's with a great company. I can't afford 2 properties. I need to sell this house, or you can port your mortgage. So if you have a fixed rate mortgage and you don't want to break the penalty, you can actually take that debt load and change the security. So you're not breaking the contract, you're not breaking the payments, and you're not breaking the interest rate. You're basically taking this product, deregistering it from one property and moving it to another, right? Now, traditionally when you're porting a mortgage, you're usually buying a property that's more expensive than the one that you just purchased, right? You're upgrading from, let's say, a condo to a house. You're upgrading from a townhouse to a single family unit, right? Any of the new money that you're requesting for the new purchase will be off here. I'll draw it out for you guys real quick. It's a whole lot easier. I like to draw. I'm a visual kind of guy. So any of the new money, I'll make a really easy example for you guys, okay? Let's say you have a 5-year mortgage. 5-year mortgage, okay? Or 60 months together, 60 months. So you're on a 5-year term. Wow, this one's toast too. Okay? So 60 months or 5 years, this is times 0 altogether, guys. So you're 2.5 years remaining on your term, okay? That means that you need to move the mortgage over and you have $100,000 owing on your balance and it's sitting at, let's call it, to make it easy, 3%, okay? Now you're saying, all right, TD, I need to port this mortgage and I need to move it to another security. I also need an additional $100,000 because that's what it's going to cost me to buy my new property, okay? I sell my property, blah, 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 everything, and I have $100,000 owing. I sell my property for $200,000. I pay TD, well, I have $100,000 owing, so I have $1,000 equity. It doesn't matter. I need an additional $100,000 of money. So what you're going to do is you're going to take this whole product right here, and this is what we're going to say. If you have 2.5 years remaining, we're always going to round off to the nearest term, okay? And at 2.5, we'll round higher. So that means that we're going to consider that you have 3 years remaining because we don't have an interest rate for 2.5 years. We have an interest rate for 2 years. We have an interest rate for 3 years. So the 3-year term at this time right now is being offered, let's call it at 4% because it's in the future and interest rates have risen, okay? So now what we're going to do is we're going to let you take that $100,000 at 3% and you're going to get your new $100,000 because we have to offer you, if there's 3 years remaining on the term, we're going to look at what we're offering for a 3-year mortgage rate at that time. And if it's at 4%, then that means 100K at the weighted average of 3%, 100K at the weighted average of 4%. We're going to give you your new mortgage. You're going to have 2.5 years remaining at 3.5% for a total balance of 200K. That way you can move the mortgage over, not pay any penalties, keep the interest rate on your old money, and this is what's called a blended rate. So we're going to blend your rate all together on the new money that you need. That way you don't have to incur any penalties, any fees, and you can actually transfer the mortgage from one property to another. That's only on a fixed rate mortgage, not on a variable mortgage. Okay?
So anywhere in Canada, doesn't matter, it's in province or out of province?
Anywhere in Canada. I can do mortgages anywhere in Canada. You can move to Montreal, man, you get me a purchase contract, a realtor and a lawyer out there, and I can service the deal and I'll send you in to sign at the branch over there. That is one of the most flexible, that is the only option that you have with the mortgage without any penalties. The other option, remember, is canceling a fixed rate mortgage and you pay the IRD or the 3-month interest, whichever is greater at the time. I cannot tell you what that will be because it depends on interest rate, time remaining, and principal, right?
So I will have 2 options, wait at the cancellation fee. One is transferring to someone else.
Correct.
The other is buying a new property and transferring from the...
And porting the mortgage, correct. So one is an assignment, and that's always tough to do because you got to find a buyer for the home, and he's got to like your terms, and he's got to like your interest rates. The only time someone will actually, someone will actually take an assignment is if interest rates are higher right now than what you had locked in. So if you're telling this guy, look, I got a 5-year at 2.89, but he was looking to buy your home at a 5-year 4.89, well, he's going to be very interested in sliding into your deal, right? Because he's going to keep all the terms the same and the interest rate the same. He can't access that interest rate anymore. He'd love to move into that 2.89, but you will not find someone to do an assignment if you've got 3.89 and the 5-year being offered right now is 2.89. Forget it. He's going to say, nah, man, I'll just finance it at 2.89. Why would I do that, right? Who would do that? Why would I move into a higher interest rate product, right? Do you guys understand what the IRD and why a bank charges a penalty on a fixed rate product? Really, really simple. Another diagram, real quick, okay? Very quick. It's simple. It all comes down to the fact that it's a fixed rate product. So if any of you guys did any business and looked at bond rates, coupon rates, all that jazz, you look at a graph, you've got basically, what is this, rates. So this is interest rate, and this is obviously your time, okay? If fixed interest rates are always based on the Bank of Canada's fixed rate bonds, Government of Canada free risk, zero risk bonds, okay? Essentially, the Bank of Canada is the cheapest pool of source of money, which is the Canadian tax base, right? Everyone gives the Bank of Canada their tax, and they raise money at no cost. So then they issue bonds, and the banks borrow off those bonds just like anybody else. So as bond prices move up, yields on bonds move up, so too the interest rates offered on bonds, which means that the bank has to borrow at higher rates. If yields on bonds move down, Canadian fixed rate bonds, interest rates on fixed rate products move down because the bank is borrowing cheaper. So what happens is, let's say you get an interest rate of 2.99%, okay? And you lock it in for 5 years. So the bank knows that at times 60, we're going to receive coupon payments at 2.99%, okay? We borrowed, let's say, at 2.79, okay? So we're making this money, we're making this spread off you, okay, in interest. And since you've locked in and agreed to borrow off us for the next 60 months, we take this spread, we borrowed at 2.79, we're lending to you at 2.99, and guess what? We're gonna lend it out at 3.09, right? So we're taking the future value of all these coupon payments, and we're now lending it today at a higher interest rate. That's assuming that we make all this money right here, right, between the spread. If all of a sudden you come up to us and say, I'm canceling this contract, right? What happens to all this money? It's gone. But we've already lent it at 3.09. So that's why in a rising interest rate environment at this time, if current interest rates are higher, right here the bank's going to say, no worries, we can recoup it because we can rewrite new contracts at a higher interest rate. But if the interest rates are lower, so in a declining interest rate environment, you want to break the contract down here, we're going to say, no problem. You got to make up the difference. That's your IRD penalty. That's the problem, because we've already made the spread up here and we've already lent against it. You've entered into a fixed contract to pay us a certain amount of interest for a certain amount of time. If we do not realize the interest and you want to break the contract, depending on where we can rewrite new contracts, whether it's at a higher rate or lower rate, is depending whether you're going to face an IRD or a 3-month interest penalty. So just remember this. If current interest rates are higher than what I've been offered at the time that I locked in my rate, I'll most likely face only a 3-month interest penalty. If interest rates are lower than what I've been offered, guess what? It's most likely to be an IRD, and I cannot tell you what it is because, again, it depends on interest rates, remainder of time, and principal, right? So that's a concept that sometimes people don't understand, right? They're just like, why is this such a penalty? It's like, because you promised to pay so much amount of interest, now you're breaking that promise. We've already lent against that future value. So I don't know if you guys got that, but that's kind of the way it breaks down. Any other questions, guys? Anything else? Home ownership? Something I wanted to mention about land titles, what Sam was saying. I've seen horror stories, guys, of people buying a property and then having registered liens, problems and issues with land titles where they're actually liable for it. So the key point that Sam said about maybe getting title insurance may not be a bad idea at all. Also, home inspection, again, huge, guys. Because
get your home inspection.
Yeah.
Right? Everybody gonna do a home inspection here?
If you buy a home, pay the $500 to get a home inspection. It could end up being the best money you've ever spent. For example, I got a great example. You were saying about the story. I got a guy who's about to buy a place for about to finance. He got the financing condition removed. The next thing was his home inspection. He said, forget it. I'm like, why? He goes, the place was perfect. My home inspector peeked into the roof, into the attic. The guy had bowls holding water. Basically, the attic was leaking so bad, and he literally had buckets holding water. And so unless the home inspector actually looks up top, then he told him, you got about $60,000 worth of roof work here and damage. So if you buy this house, in order to keep it like livable, you're gonna have to spend 60 grand. He retracted his offer. And that's the thing about conditions on a contract, guys. Your condition, when you set a condition on the contract, financing inspection, condo docs, or home inspection, that is your exit to get out of the product, okay? 2 things happened if you don't remove your condition by condition date. The contract is null and void. You could just not call the seller anymore. If he doesn't have that piece of paper saying that you removed your conditions, it is not a firm deal. It is not legally binding, okay? If you give the seller, you remove your conditions from a contract, you are legally bound to buy that property. And guess what? If you can't get the financing, or if you can't get, for any reason you can't buy that property, and you cause that seller undue financial harm, guess what happens? Because sometimes people will have a condition that says, I will buy my house, okay, Sam's selling me a house, okay?
You lose your deposit.
You can lose your deposit, and so Sam's selling me his house, and I say, okay, Sam, I need condition of financing, right? It's condition of financing, condition of inspection, and that's it, okay? As long as I get my financing in place, my inspection in place, I'm good. I get my financing approved by the bank, fantastic, that's for me. I do my inspection report, fantastic. I tell my realtor, I'm going to write off that I've removed my conditions, okay? So I remove these conditions. I send Sam a letter saying I've removed my conditions. Sam says, excellent, man. That's perfect. I've sold my house, okay? Now let's say that your financier screwed up at time of financing. He's like, you know what, man? I actually didn't get you approved, which is horrible on his part, okay? Never tell someone to remove conditions unless you're absolutely certain, okay? Now I don't have financing in place. If I don't give Sam, I can't get Sam the money from the bank to buy his property, and he can't sell the property to me anymore, I default on the purchase, 2 things happen. Sam keeps my deposit, no questions asked, And on top of that, if I caused him any issues, he may have needed to sell his home to buy the other home that he's buying. If you make him default on his property, guess what? And they keep his deposit, guess what he's doing? They're keeping his deposit. He's going to turn around and say, I'm suing you in court for that deposit money that I lost because you didn't buy my house, thus I couldn't buy my house. And shit rolls downhill, guys. You guys got to know that, right? So bottom line, never remove your conditions unless you are absolutely certain, okay? That is number one. If you're not sure, what I tell clients is, it's better to just walk away from the deal and live to shop another day than to put yourself in a precarious situation where you're not certain about financing, you're not certain about the home inspection, or you're not certain about the condo docs. I've seen it happen. It's not a pretty picture. It's bad news for everybody, okay? Just not fun. So remember, conditions is your exit strategy. For any reason you do not want to continue on with that purchase, do not remove your conditions, and it is not a legally binding contract. Good, guys?
Thank you.
Any other questions?